Welcome to this week's episode of Jonathan on Money. This is episode number 145. Well, I just got back from yeshiva break. My family and I went down to Miami. It's the only type of trip I really go on where I have no itinerary. Normally, as listeners know, I plan my vacations to the hour, which sounds sick, but it's what I do to accomplish as much as I can in my time off. However, Miami is usually different where we just try to make the most of the warm weather. In fact, I bribe my kids per lap. They swim in the pool. I'm a big fan of incentivizing my children if it means creating healthy habits. My rate is 10 cents per lap, and I'm told I owe quite a bit of money, which I'm happy to pay. It certainly beats sitting on their tush and watching their iPad all day, which I'm sure many folks that are listening to this will agree with. In terms of restaurants, which I'm sure many of you are wondering, I don't get overly jazzed about the food in Florida. My thought is this: if the same places were in New York, they wouldn't be as noteworthy. But because they're in Florida, people get overly excited about it. A few notable exceptions to this general philosophy is the pancakes at Tasty Beach Cafe, which are absolutely geschmack, the food at Zach the Baker, which is the only restaurant worth waiting online for, and Levy Shawarma, which has the best babka, ironically, in the Western Hemisphere. And their Middle Eastern cuisine is also quite good. We also went to a fun Argentinian steakhouse called La Matera, which was tasty and the kids had a good time. It was my daughter's birthday, so we figured we'd do something special. The waiters came out and sang happy birthday to her in Spanish, so that was a moderately exciting experience. And speaking of special, I went with one of my kids to the Miami Heat versus Oklahoma City Thunder game on Saturday night. Phenomenal game, and we had great seats. This comes back to my philosophy of spending on things that are important to you while cutting spending on things that are not important. We got great seats for the game, but only went out to eat a few times that I mentioned, and mostly eat eggs and yogurt from the fridge most of the vacation. Everyone needs to find their financial balance so they can live their own personal rich life. Anyway, that was the last vacation until the spring. Now it's back to the grind. And in other news, here's a reminder about my first book, D's for Diversification, the ABCs of Personal Finance, which is available now on Amazon or at jonathanonmoney.com. And the book is a fun way to plant the seeds of financial literacy, perfect for families with young kids or anyone brushing up on the basics, and a memorable gift that helps raise money smart kids. And finally, before jumping to this week's episode, I'd like to share that my upcoming live webinar will be on Thursday, January 29th at 8:30 a.m. featuring Elizabeth Forspan of Forspan Clear based in Great Neck, New York. And Elizabeth will be speaking on the very important and timely topic of overcoming estate and elder care planning hurdles. This program will also offer CPE and CLE credit to accountants and attorneys in New York and New Jersey. And I'll be sure to include the registration information in the show notes to this episode. Okay, now for today's agenda. My talking points this week will discuss how raising money smart children starts earlier than you think. Our quote this week is from Burton Malkiel on different types of market forecasters. I'll spend the last half of the episode answering listener questions, including thoughts on the WNBA versus NBA earnings disparity. And finally, we'll end with an actionable idea to implement to your investing life. We'll discuss how to best invest in the AI revolution. And with that, let's jump into this week's talking points. So, most parents want to pass along good money habits to their children. After all, understanding how money works and how to use it to improve your life is an essential lifelong skill. The challenge is that most children have little interest in personal finance until they graduate college. When they suddenly need to pay rent, they start to pay attention, but by then they're already playing catch up. Parents often ask me for advice on instilling strong financial values and foundational knowledge early so the basics feel familiar when their children eventually take responsibility for their own money. I always say the key is making the lessons accessible and meaningful at each stage of a child's development. Drawing on nearly 2 decades of working with families, having my own children, and being a child once myself, I've identified 3 practical strategies that help children build financial confidence from a young age. The first is to engage in relevant casual money talk. As a parent, I've long ago realized that the best way to get my children engaged in a topic is to simply introduce them to an idea and let them develop an interest on their own. Young children are naturally inquisitive. If you bring up an interesting topic, they'll follow up with lots of questions. On a family road trip this past summer, after stopping at both Walmart and Target, I casually mentioned to my 9-year-old that she owns both of those stores. The intrigue generated some questions from her, which sparked conversation and ultimately led to discussion about the difference between owning companies by buying stocks and lending a company money with bonds. I used her lemonade stand to further illustrate the concept. If she wanted some money to expand her stand, she could sell me a share of her business and I could be part owner, i.e., stock ownership, or I can lend her the money and she can pay me back with interest later, which would make me a bondholder. The same concepts are applicable to large companies. While she wasn't inclined to give up any of her lemonade stand profits, she now understood the difference between stocks and bonds. Sensing I was on a roll, I also showed her on my phone the many companies that make toys or games she's familiar with and that she could partially own. I showed her that the maker of Barbie is Mattel and the owner of the game Monopoly is Hasbro, both publicly traded companies. This led to 10 minutes of her searching for a company, looking at what they were trading for and whether they paid a dividend. The entire exchange was under 30 minutes, but it had a lasting impact. A few weeks ago, we were waiting at our gate for a flight back to New York. My daughter asked me to use my phone to look up companies. The key is starting these types of conversations early, not forcing them, and meeting children where they are in life. Discussing toys, lemonade stands, and companies that children are familiar with is a lot more effective than discussing earnings per share, EBITDA, and technical analysis. The second point is to embrace healthy financial habits because your children are watching you. One thing every parent should remember is that your children are watching you. We've all had that moment when we say or do something we shouldn't, only to hear or see our child repeat it minutes later. Money habits work the same way. Many of the financial behaviors we carry into adulthood, both healthy and unhealthy, come directly from how we were raised. I work with wealthy clients who will never run out of money in their lifetime, yet struggle to save to spend an extra $20 on a small convenience because they grew up with parents who saved every penny out of fear. Others feel pressure to buy the latest luxury items because that was the norm in their childhood homes. Some adults become stressed or even physically uncomfortable at the mention of money because finances were a constant source of tension when they were young. Of course, many families model the opposite, living within their means, saving consistently, and avoiding unnecessary spending. Plenty of investors recall watching relatives review stock quotes in the Wall Street Journal, collect dividend checks, or use their resources to support loved ones and meaningful causes. A crucial part of raising children with a healthy relationship with money is embracing healthy financial habits yourself. Treat money as a tool to achieve your goals, not as a scorecard, not a source of anxiety, and that mindset will naturally pass to the next generation. Act and speak intentionally about money in front of your children. They're paying attention. And finally, there's incorporating financial literacy into the school curriculum. There has been a growing push to include personal finance education in school curricula. It's a worthwhile goal, but the challenge lies in making the material digestible for students who aren't naturally thinking about money yet. A more effective approach is what I call the slow drip method, which is introducing financial concepts gradually throughout elementary, middle, and high school rather than relying on a single senior year course. The lessons that stuck with me as a student were the ones I encountered repeatedly. A one off personal finance class at the end of high school is easy to forget, but exposure to investing, planning, and financial decision making over many years helps embed these ideas so they resurface later when students enter the real world. Practically, this could mean dedicating a few history classes to the evolution of markets, the history of the US stock market, and major investment bubbles. Math classes can incorporate budgeting, the time value money, compound interest, and basic insurance statistics. Revisiting and building on these real world concepts throughout a child's academic journey would be invaluable. Unlike the strategies parents can implement at home, the effort requires collaboration with school boards and educators. However, the long term payoffs of financially confident, better prepared young adults is well worth the effort. Keep in mind that you were once a child. It helps to think back to your own childhood and remember what actually captured your attention. When I was growing up, my priorities were simple: playing sports, hanging out with friends, and getting decent grade to avoid my parents' dismay. Personal finance wasn't even on my radar. Looking back, though, I realized how much I benefited from casual conversations about money and seeing strong financial role models in my parents and grandparents. My father even had me open up a Roth IRA at 16 when I had my first summer job. I would have benefited even further by having these concepts woven naturally into my school curriculum. By meeting children where they are and introducing money lessons in small, meaningful ways, parents can give children a head start towards confidence, competence, and a healthy relationship with money. Okay, those are the talking points this week. As a reminder, you can be notified of all my recent articles, webinars, and all the work I put up by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Burton Malkiel. For those who don't know, Burton Malkiel is an influential American economist, author, and investment theorist, best known for shaping modern thinking on efficient markets and passive investing. He was a longtime professor of economics at Princeton University, where he taught for decades and later served as chair of the economics department. Malkiel gained worldwide recognition for his 1973 book, A Random Walk Down Wall Street, which argued that stock prices largely reflect all available information and that consistently outperforming the market through active stock picking is an extremely difficult proposition. The book popularized the efficient market hypothesis for a broad audience and helped lay the intellectual foundation for index fund investing. Beyond academia, Malkiel plays a significant role in the investment industry. He served as member of Vanguard's board of directors for many years. He also served as the president of American Finance Association and advised institutions and policymakers on financial markets. And Malkiel once said, there are three kinds of people who make market predictions. One, those who don't know. Two, those who don't know what they don't know. And three, those who know darn well they don't know, but get paid big bucks for pretending to know. It's amazing to me how most people, and I will say most people, get fooled by professional market forecasters who state boldly their views on the market but are usually wrong. They may be extremely knowledgeable on certain sectors, market history, and even proper portfolio construction, but that does not mean they can predict the future. For investors who embrace the reality that no one can predict the future, especially in the near term, and instead focus on positioning their financial life accordingly, they will be in good financial shape. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me and it may be answered in a future episode. Okay, first question. Is private credit entering a bubble with so many providers coming out with funds and ETFs featuring this category? So every asset class goes through cycles. Private credit is no exception. There's been a lot of buzz around this area for some time. There have also been many more players coming into the space. Furthermore, at some point, banking regulations will ease and there'll be yet another competitor in this market. If I was a speculator, I would say private credit is near the peak in the cycle. A good indicator of peak is in any cycles when the most unsophisticated investors and large money management firms start piling into a specific area. This has happened over the past couple of years in a big way. There will be more defaults and the returns on the loans they make will be more muted. Of course, this is a very large area of the market and there will undoubtedly be winners and losers. However, you won't be able to pick the winners from the losers. I'd sooner get my credit exposure primarily through high quality bonds and my growth from equities. This way you can sidestep the inevitable implosion in this space. Next question, and we can see how backlogged I am from this question. How much is too much to spend on a siyum per person during the 9 days? And this obviously was sent to me this summer, but I am working through a backlog of questions. The answer is $0 should be spent on a siyum during the 9 days. Zero. The motivation for so many people to plan their siyum to take place on the 9 days by exploiting a loophole just so they can stuff their face with meat is in poor form. The 9 days are a very bad time for Jews throughout history. In today's world in particular, we should take the time to reflect on our history and the hardships we faced from anti-Semites all over the world. If I may, I'd like to quote Ecclesiastes, which states, "There's an appointed time for everything, a specific season for every activity under the heavens." When Tisha B'Av occurs, it's a time for a year to be sad and introspective about the hate and hardship our people have faced and continue to face. I recommend postponing your siyum by an extra few days and then spend however much money you want as long as it doesn't derail your finances. Next question. What are your thoughts on the WNBA players earning substantially less than NBA players? Do you think it's fair that they're not paid comparable salaries for their hard work? Fair? Since when do things need to be fair? But let's not focus on the need for fairness, which is another rant altogether. Let's focus on the numbers. The NBA is a business, and so is the WNBA. Well, sorta. The NBA generates billions of income a year after expenses. Billions. The WNBA loses tens of millions of dollars a year. loses. So they shouldn't be paid anywhere near the same as the men for playing basketball. Until this point, their parent organization and employer has lost money. Contrary to what many people in our country seem to think, we live in a capitalist society where, for the most part, folks are rewarded based on their success. Other than most mid level managers at money management firms who I had the unpleasant experience of interacting with, they are promoted on their ability to navigate corporate bureaucracy without offering any value to colleagues or shareholders. The WNBA is not a successful enterprise yet and is kept afloat by the NBA. Until we have our first socialist president who decides where private corporations and private citizens' money should be sent, we will have to deal with this meritocracy. Now, to get paid to travel the country in order to play basketball is a pretty nice gig. In fact, it's a pretty privileged gig. For players who aren't satisfied with their paycheck, they can take their skills and go into another line of work where they believe they will be paid more. Alternatively, they could do what some WNBA players do and use their popularity to get endorsements. According to a quick Google search, Caitlin Clark makes approximately $11 million from endorsements. She capitalized on the exposure the WNBA gave her. Kola kavod to Caitlin. Bekitzer, the money for bigger paychecks needs to come from somewhere, and when you work for a money-losing organization, high salaries are not feasible except within the federal government. Next question. My parents have a few $1 million but just retired and have no long term care insurance. How do I protect my inheritance so they don't spend all their money on long term care needs should there be a need? Well, the first thing they can do if they are young and healthy enough is they can purchase some form of long-term care insurance. This may be a traditional policy or a life insurance policy with a long-term care rider. They're not in optimal health. They can do Medicaid planning where they put all their assets in irrevocable trust. And even though they'll lose control of their funds, the government will pick up their long term care costs if all the rules are followed correctly. Another option is moving to a country with socialized medicine like Israel, where paying for long term care coverage may not be as financially onerous. There may be other options depending on the specific circumstances. The key point is that whatever option your parents choose, there will be trade offs. It may be lack of control, hefty premium payments, the inconvenience of moving, and others. And the best type of planning for long term care should have taken place decades ago before retirement. In terms of your inheritance, I suggest investing in your career and your own investments. This way, you won't need to rely on anyone else's money to fund your lifestyle. Next question. I'm repositioning my portfolio. Should I wait until after Tisha B'Av to do so? Or is that just silliness? Another Tisha B'Av questions. I apologize for that because this is coming out in January. Just file this one away for the summer. So, of course, you should wait. The 9 days is a bad time for Jews. As long as you have a bit of flexibility, then you should hold off before doing any serious business. During this time of year, I tell any from clients who reach out to me they should wait until after Tisha B'Av to do anything unless it's time sensitive. That was my Zaidi's minhag. He would call me daily to discuss the stocks. That's what he enjoyed talking about, in addition to right wing politics, Israel, and Daf Yomi. And then after a whole discussion, he would tell me to wait until after Tisha B'Av before making any moves. Prudent, sensible, and wise. Old European men from the Carpathian Mountains have their priorities straight. Listen, everyone has their personal Jewishness that they are strict about. Some people only eat dairy foods that are Chalav Yisrael. Others like to shush people during davening. Some people are strict about finding ways to eat meat during this time of year. And I take the 9 days very seriously. It's more logical than many of the customs we've embraced in our community. Next question. I see some nice income funds paying 7%. Why not just buy one to generate income in retirement? Let's back up, brah. First of all, what are your goals? Is it just to generate income or do you have legacy goals? How old are you? What's your risk tolerance? Those factors will help assess what asset allocation is sensible for you. Now to income funds. This is a very, very general term and may encompass many different types of mutual funds that generate income. You need to look under the hood and determine how this fund is invested. Is it mostly invested in junk bonds and MLPs, which pay a high dividend but may not appreciate much? Is this a closed-end fund that uses lots of leverage and will be quite volatile and will likely plummet in value? Is it a diversified fund of high income producing producing investment? If so, this strategy is likely generating income at the expense of not investing in areas of the market that experience more capital appreciation. Remember, just because a fund generates a high income does not mean it will appreciate over time. You may be stuck with a fund that throws off income, but whose price remains stagnant for years, which is not the best vehicle in retirement when you need to outpace inflation. Finally, just because the current yield on this fund is 7% does not mean it will throw off 7% returns consistently in perpetuity. The income generated will likely fluctuate, and you need to adapt your lifestyle accordingly if it's your main source of cash flow. As they say, Bekitzer, an income fund can mean a lot of different things, but it's certainly not a sustainable strategy for all your money. Next question. What's a 501c4? I want to give to a particular nonprofit I saw. It was characterized as a 501c4. Any suggestions? Any ideas? This is a good Shiloh. Let's back up a second and discuss 501c3s as a point of comparison, which are nonprofits created for religious, educational, scientific, or charitable purposes. Donations to these organizations are tax deductible. There are restrictions like limited lobbying, and they cannot endorse political candidates. For example, this includes American Red Cross, which is an organization that provides disaster relief unless it involves helping Israel, Habitat for Humanity, which is housing support, Jewish federations, which are community services, and St. Jude's Children's Research Hospital, which is medical care and research. On the other hand, 501c4s are social welfare organizations that focus on advocacy and public policy to promote social welfare. Donations are generally not tax deductible. They can engage in unlimited lobbying and endorse political candidates. Examples of this include the National Rifle Association, which is for gun right advocacy to keep our country safe. Planned Parenthood Action Fund, reproductive rights and lobbying, and AARP, which is his senior advocacy and policy influence. If you don't mind not getting a tax deduction, but are passionate about the work of a particular 501c4, then make a donation. Money is about living your best life and not necessarily about pursuing optimal tax efficiency. Next question. You discuss investing in Israel from time to time, but let's say I want to support Palestinian through investments. How do I do that? Please keep my question anonymous because I don't want your right-wing fan base to hound me. I didn't think I had such a right-wing fan base, but that's fine. I hear your question. The problem is that being part of a death cult does not lend itself to entrepreneurship, progress, and advancement. This is why I can't find much information on the Palestinian Stock Exchange, ETFs that track this market, or companies on the exchange. I actually can't find any innovation that takes place in that region at all, other than devising new ways to kill Jews and use their own people as shields. There are some companies based in the Judea and Samaria area, but many of the largest employers are international companies based elsewhere. Perhaps if the Palestinians spent more time investing in education, infrastructure, and innovation instead of killing Jews, they would have more time to show for their few decades-long history. By way of comparison, the reason I talk about investing in Israel more often is because they have 580 publicly traded companies. This doesn't even include the many major tech firms around the world in Israel who have offices and R&D facilities in Israel as well. As a wise people once said, Am Yisrael Chai. Next question, what's the difference between an estate tax and an inheritance tax? So an estate tax is based on where the dead person lived, and an inheritance tax is based on where the beneficiaries live. So for federal estate tax, the estate of the deceased pays tax on the total value of their assets before they're distributed to heirs. It applies on a federal level on estate exceeding $15 million. On a state level, 12 states plus Washington, D.C. also impose estate taxes above a certain threshold of assets. On the other hand, inheritance taxes are paid by the beneficiaries, i.e. the heirs, and the amount that is taxed is what is inherited by each individual. There is no federal inheritance tax, and only 6 states impose it. This includes Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. Not a super complicated concept, but since every state has its own rules, it could seem convoluted, kind of like our tax system in general. Okay, that's it for financial questions. And by the way, If you have a more involved personal finance situation, feel free to reach out directly to me and perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely and actionable idea that listeners can implement to their own financial lives. And today's timely idea is regarding how to invest in AI. How to invest AI or artificial intelligence. So I often get the question of how do I recommend adding AI investments to your portfolio? What are specific companies benefiting from AI? So my point of view on this is I think that all companies who are serious about staying on top of the latest technological trends will benefit from AI. A company does not need to be a producer or manufacturer of AI technology to benefit from it or by becoming efficient in their own processes, which can improve their bottom line. I would not recommend speculating on individual stocks as your play on AI. The reason is it's extremely difficult to know who will be the winners and losers from this AI trend. In other words, you and your financial advisor will not be successful in picking winners and will likely pick the laggards in the space. That's just the way stock picking works. My preferred method to gain exposure to this emerging technology is the use of market weighted index funds. The best companies will rise to the top and you will benefit that way. The way this may not be exciting, but sensible investing rarely is. Okay, with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.